Hey everyone, Jeff Dorman, Chief Investment Officer at ARCA, back for another edition of That's Our Two Satoshis Live, where we're going to talk about what's going on in the digital asset market. As most of you know, we also write a weekly blog. You can find that on our website at ar.ca/blog, where we kind of go through what's happened in the week, what's relevant to markets. Before we get going today, as always, this commentary is not intended to be investment advice, investment research, or a recommendation. Please consult your investment professional for your own circumstances. So, last week was a down week for the markets. The S&P 500 fell a little over 1%. Digital assets fell in the 5 to 7% neighborhood, although, bouncing back pretty well today, showing some resiliency. But it's interesting. We've been talking about macro for, most of the last 14 months. Yesterday on Monday was a pretty good indication that macro, again, is just not in the driver's seat, right? We had equities rally pretty hard while digital assets fell. And the reason digital assets fell was, of course, we had more negative regulatory action, this time against Paxos and the Binance USD stablecoin. So, really this is the driving story of digital assets right now, is we have an onslaught coming from regulators. Rather than talk about sort of macro, I'll start with the micro, because I think it's important to kind of go line by line in terms of what just happened. So let's start with Kraken. The SEC charged Kraken with failing to register the offer and sale of their staking as a service program. I think the common narrative was that this is now an attack on all staking products, as well as even potentially trying to label ETH and some other tokens as securities. I just don't think that's the case. If you actually read what happened and you actually look at the video and the press release themselves from the SEC, it seemed pretty clear that they're really going after Kraken specifically for how they marketed this product. And we'll get back to that in a second. The other, of course, is what we just mentioned with Paxos facing an SEC lawsuit over BUSD, the $16 billion stablecoin. This was a little harder to figure out exactly what the takeaway here is. Again, I think the common narrative is that this is an attack on stablecoins, and that this is clearly going to start labeling all stablecoins as securities. This one's harder to interpret because we haven't actually seen the Wells notice or any of the actual documentation behind what Paxos is being charged with. But reading through the tea leaves, again, it does seem to be a Paxos and Binance specific problem, specifically around the fact that BUSD is issued both on Ethereum. 11 billion of the 16 billion is on Ethereum, as well as on Binance Smart Chain, where the other 5 billion is. And I think there might be some issues with regard to how this stablecoin has been basically wrapped across multiple chains. But more importantly, I think there's a couple takeaways here, right? First and foremost is the market is still responding to individual and idiosyncratic news. On the heels of the Kraken news, Kraken makes up 7% of Ethereum staking. Well, immediately when Kraken basically exited that business, you saw a pretty strong rally in the other liquid staking providers that are on chain, that being Lido and Frax and Rocket Pool. Similarly, when you had the news about Paxos shutting down, not only did a lot of this flow end up in Tether, in fact, Tether traded above $1 briefly as some of the curve pools were drained as people sold BUSD into Tether. But also, you saw a rally in some of the algorithmic stablecoins. So that being Frax and to some extent Curve and Aave, since they're coming out with algorithmic stablecoins soon. And then, of course, Maker with their DAI stablecoin, which is about 5 billion in AUM. So good to see the market responding to events in terms of figuring out who the winners and losers are of these events. But I think more importantly, many of you probably read Nick Carter from Castle Island's op-ed talking about this being Operation Choke Point, right? That basically various parts of the U.S. government are attacking the banking industry specifically to try to put a choke point on the digital asset industry, meaning if you can't get banked, you can't do much, right? And this comes from what happened in the Obama administration in 2013, where a similar Operation Choke Point was initiated, which targeted gun and ammunition dealers, payday lenders, and other businesses that were legal businesses, but basically went against the view of the Obama administration. I think that's what people are assuming, or at least Nick Carter is assuming here, is that that's what the current Biden administration is doing. They don't like blockchain. They don't like digital assets. they want to choke off this industry by cutting off the banks. But I think, I have two, I guess, contrarian and certainly controversial viewpoints on what happened last week. The first is that I actually think the SEC and Chairman Gensler were right with regard to the Kraken ruling. And the second is that, I don't actually think Operation Choke Point is happening, but if it were, I actually think it would be bullish for the industry, or at least for prices of tokens rather than bearish. So let's start with the first one. If you actually watched Gensler's video, it was pretty clear that the issue was not with staking itself. In fact, later he even went on CNBC and said, not your coins, not your crypto, which obviously references more about this being a problem with using a third-party intermediary than it was holding your own tokens. And the reason I don't think this is related to staking at all, and it's really more related to Kraken, is that if you look at the troubled service providers of last year, namely Celsius and BlockFi and Genesis and Voyager, they all had the same issues, right? Which is that they were promising yield, but not necessarily disclosing or explaining where that yield is coming from. And when that happens, what you're doing is you can basically combine a lot of different things into that yield. I may stake in Kraken's staking as a service program and think that I'm getting just the variable yield that comes for staking ETH. But in reality, Kraken controls whether or not they pay that distribution and how they make it up. It could come from private investments into Kraken equity. It could come from marketing spend. It could come from rehypothecation of other assets. And of course, probably comes a little bit from staking as well. And it sounds like that's what the SEC was most concerned with, is that if you're going to package a yield product without disclosing where that yield is coming from and basically taking that yield from a variety of different places, then that is a security offering, right? And I think that is true. This industry does fail often with disclosures, and it certainly is opaque with regard to where these returns are coming from. And I think that is, largely what is the issue from the SEC. Now, most people saw also that SEC Commissioner Hester Peirce rebutted and basically said that, whether or not the Kraken product was or was not a security doesn't really matter, because the fact of the matter is there would be no viable way for them to register. And I agree with that as well. I think that's the biggest issue, and Coinbase and others have pointed that out, that there's really nothing you can do to register as a security right now in the digital asset industry, because it runs into issues with qualified custodians and how you would actually go about having a security. But that's besides the point, right? That doesn't excuse the products themselves from being, somewhat predatory and certainly opaque. But we have a long way to go until companies in the United States are able to issue products that are compliant with the SEC rules. So we'll move on from that one. I think if you move on to Operation Choke Point, I think this one is probably even a more controversial take, which is that I don't actually think if banks get shut out of this, if the Biden administration really does basically encourage all banks in the US to avoid anything related to blockchain and digital assets, it sounds horrible, right? It sounds like this industry is going to stall. It sounds like we're going to see slow growth. But you have to remember that there is only about $1 billion of liquid tokens right now. And of that, almost a half of that is Bitcoin itself. Another quarter of that is Ethereum. And almost another quarter of that is stablecoins themselves. It's a very, very tiny fraction of the overall market that is other tokens, meaning other layer one protocols, DeFi, Web3, NFT related tokens as well. So if you actually do make it where it's very difficult to get money in and out of the system, especially when you start to lose confidence in stablecoins because of regulation happening there, it doesn't necessarily mean that prices go down. In fact, what you probably see is the opposite. You probably see everybody rush to get out of stablecoins and into other tokens that are just as fungible across state lines and across country lines, but actually offer some upside as well. And there's some merit to thinking this, right? If you go back to when FTX cut off withdrawals, but the FTX site itself still worked, there was a flurry of trading activity. I mean, a lot of people basically said, I know my assets are going to be lost on FTX, at least for a long period of time until we get through bankruptcy, but I might as well try to earn as much money as I can in the process and build that estate. I think the same attitude would happen in digital assets, which is if it starts getting very hard to get your money back into the banking system, you're probably going to try to just increase as much of your positioning as possible, waiting for the next administration, right? Because anything that happens under the Biden administration is going to be unwound in 2 or 6 years anyway, when a new administration comes in. So in the meantime, if think of it as if I think I saw somebody on Twitter who wrote, if there's a fire at the casino and the doors are locked, you might as well just play blackjack. And that's kind of what I think would happen with the digital asset world. Is if we're trapped and we have all this money and energy trapped in here, might as well earn as much as you can and wait until the administration changes and you can get that money back out. So I don't think this is that big of a deal. First of all, again, I'm not even 100% sure that what was written about Operation Choke Point 2.0 is even real. There's just for every bank that is being encouraged to shut off access to digital assets, there's a new one around the corner trying to get involved. So I don't think it's as draconian as Nick stated. I think it's a little bit hyperbolic what he wrote. But again, that being said, I think the market is rushing to judgment that this is negative, and in fact, it may actually backfire by the Biden administration. Moreover, I think it's probably going to encourage monopolistic behavior. Right, one of the things that's happening right now with regulation is they're really making it harder to get into this space. Right, there used to be very low barriers to entry. Anybody could spin up a lending product. Anybody could spin up an exchange. Anybody could spin up a stable coin. Now it's much harder, certainly here in the U.S. As a result, the rich are going to keep getting richer. Binance currently captures about 78% of centralized trading market share. Uniswap has about 80% of decentralized spot trading. DYDX has 70% of decentralized derivative trading. Ethereum has 65% of the TVL. Tether has 65 to 70% of the stablecoin market. Those are just going to keep growing. When you basically cut off access and make it harder for new entrants and for competitive behaviors, you're just going to create monopolistic behavior. So with high barriers to entry now, I think the Biden administration may think they're killing the industry, but the opposite is probably actually true. They're just going to ensure that the incumbents win. They're going to ensure that token prices go higher, services all start to move on-chain or offshore, and ultimately, the onus will be on token issuers themselves to start creating some actual value for their tokens, rather than having it just be something that accrues, dollar value waiting to be sold. So we'll see what happens here, but my guess is we'll continue to see regulatory actions. We'll continue to maybe see short-term market sell-offs based on this, but I think the market will be much more resilient than most people think. And I think most of these dips, just like we saw in the last couple of days, will be bought pretty heavily. So that's it. I encourage you guys to read the blog. As always, went into a little bit more detail there if you want to check it out. But we're pretty encouraged by the price action, as well as everything that's happening in the digital asset space outside of regulation. And we'll see what happens next week. So that's it. Appreciate everybody listening. Have a good week. And that's our 2 Satoshis.